Joining our series on this episode is Rahul Bharara, Managing Director and Head of Real Estate for Australia at Credit Suisse. Rahul, always a pleasure speaking with yourself. I want to open up our discussion by exploring your perspective on the macro events at play at the moment. What's your reading on the level of volatility that are affecting public markets?
Thanks again, Rob, and thanks for coming across to the office. It's always good to catch up in person. As coming out of lockdowns, this is a unique experience, meeting people face to face, but certainly something that we've been looking forward to. Look, I think if you look back at 2021, that's actually an anomaly, right? There was just one straight line with the markets going up and everything basically going up on the back of excess liquidity, great interest rates, etc. But if you look back historically, every year is not like that. And I think 2022 is going to be one of those years where high quality companies, certainty of income, coupled with if you have a natural inflation hedge, and we can come back to why a lot of real estate has that. I think those, once we get through the indigestion, which might happen with some of the talk around rate rises and some of these rate rises actually happening, once we get through that, I think some of those will actually really shine. It's not going to be everything goes up in a uniform sort of line, but the good quality stuff certainly will.
From an inflation perspective, are you in the transitory camp, or do you think it's more of a permanent theme that we're starting to see emerge?
Look, I think my personal view on this is, and actually this is an interesting morning to be chatting to you, right? We've just had the CPI print in the US at 7.5% annualized for Jan. So inflation is running hot globally. In fact, I think in certain markets offshore, far hotter than what we're seeing in Australia. I do think certain items like commodities, etc., are going to remain hot over the course of 2022. But these things move in cycles, and 7.5 is not sustainable. A lot of this is also led to by supply imbalances, which have been playing out. Shipping has been impacted for the last 12, 18 months, as we all know. Shipping prices have been impacted, but as things come back and lockdowns hopefully are a thing of the past, that normalcy comes back, and we should hopefully normalize over the course of what I'd say is the next 6 to 12 months.
So what about then in terms of interest rates? What impact would an interest rate rise have on the property sector?
Again, it would depend on what sort of property you have, and why the interest rate rises are happening. I mean, as we all know, interest rate rises are happening on the back of what is a hot inflation environment, and central banks, using that lever to try and cool down demand. But it depends on what product you have. So I'd sort of take an example of apartments in New York. There's been 20% rental increases, and on some reports actually saying that rents in New York are actually above where they were pre-pandemic. That's driven by obviously supply and demand, but also by pretty significant wage inflation that's going through. So there are going to be a lot of pockets of real estate that actually can be an inflation hedge in this environment, and we can talk more about that. But I think if you've got earnings going up, we think a lot of the real estate will still keep on doing well once we get through that initial what I've mentioned as indigestion.
There's been an enormous level of M&A activity and IPO activity over the past 12 to 18 months. Reflecting on that period, what's driving this level of deal flow in the market?
Yeah, again, great question, right? I mean, but there is a secular theme that we've got, which is, you've got pension funds with very significant pots of capital, not just in Australia, but you look at Canada, you look at Asia. There is a lot of capital that's coming through. Their interest in real asset, it's a pool of capital that you've got chasing a scarce supply of real estate and real assets. We've seen that play out actually last year, even more so in the infrastructure space. And this year, in the direct markets and last year in the direct markets, real estate is absolutely something that people are increasing their interest in and actually increasing their allocations towards, right? So what that's doing is creating a lot of demand for product, not just listed, right? So M&A is one aspect, and we haven't actually seen that much of real estate M&A in terms of large scale, unlike what you've seen in infrastructure. But we have seen, generation of new product. We did a couple of IPOs last year, which had pretty decent take up. There's just a general interest and demand for real estate assets across, both from the listed markets, the private markets as well. And we see that as I'd say, more of a secular long-term trend, where that demand for real estate will stay strong. Because as populations are aging, you need to get a real return. You're not getting that in the bank, and certainly not today when inflation is running hot.
How attractive is Australia as a destination for global capital when it comes to real estate markets at the moment?
I think it's an extremely attractive destination. I mean, you just have to look around, and you've got, aside from a legal system which stands up against the best in the world, it is a very, very attractive destination. I think there's no hiding from the fact that with the borders being locked down, which for health reasons, and you can't sort of dispute that. But with things opening up, you will find more capital flowing into Australia to try and pick up what is a scarce pool of assets in Australia.
In terms of then the challenges, what hurdles do you foresee either over the next 12 months or beyond for investors investing into Australian commercial real estate?
Again, I think it comes down to what you can actually access, right? So the issues in Australia are, can you access large pools of assets? That tends to be the biggest challenge for some of these larger pension funds, or if you need to deploy a couple of $1 billion of capital. Historically, we've really just had two sectors: the large shopping centres, or large office assets similar to what we're sitting in the CBD. The problem is for us is actually trying to find pools of assets in some of these sectors, which we refer to in Australia as alternatives, but are very mainstream elsewhere in the world. Whether it be childcare, hospitals, a lot of these social infrastructure sectors, which have been getting a lot of airtime globally. We just don't have large institutional pools of capital for it. Of products, sorry, my bad.
Based on what you're seeing then, which investment products do you think, or which investment asset classes are proving most resilient?
So, look, I think the resilience point was sort of borne out during the pandemic. Clearly, if you had long WALE, triple net leases, they did really well, especially if you were in, if you were in a Bunnings warehouse property, or if you were in, a grocery-anchored retail, if you were in healthcare property, or logistics, for example. Logistics has had a phenomenal run, right? A lot of that was based on increasing asset values. What we're seeing now in logistics is the next front, where rents are actually on the ground increasing, and that's again driving a lot of interest and demand. Over and above all of that, in Australia, we're just underallocated to these assets. So that is the real challenge we've got when you look outside retail and office. But for me personally, I think going forward into 2022, I think it's the reopening trade, which is going to be really interesting. So it's the offices that we're sitting in, it's the shopping centres where we go and purchase stuff. It's the student accommodation assets, right, which are more than just apartment buildings, because they create, aside from a financial gain or a financial impact, they've got a very significant non-financial impact as well. The vibrancy of the CBDs, the fact that project Australia globally, and then there's a multitude of other benefits. So what I'm most interested to see is what actually happens to a lot of the reopening trades in 2022.
Let's talk about REITs. Where do you assess REITs sit comparative to private markets?
Look at, as we're sitting right now in Feb 2022, REITs are trading at majority of REITs, not all of them. I think majority of REITs are trading at a pretty significant discount to where the direct markets are sitting.
Why is that, do you think?
Look, I think part of that is, you'll always find this in listed markets. There'll be up and down, and there'll be times when pricing isn't the most efficient. Inherently, some of the investors in the direct markets are sort of taking a 10-year view when they come and make their investment, as opposed to sometimes in the listed market where the time frame might be shorter. But everything pans out, and at the end of the day, nothing stays at a big discount for too long. The markets tend to correct themselves, or management teams and boards tend to find a solution. But it's not. I don't think it's a challenge in the short term. If that discount sort of prevails over I'd say the medium to long term, then that's probably a challenge.
What's your perspective then on cap rates? Have these changed materially, and if so, what have been the driving forces behind these changes?
I think I'd probably step back and say asset values have risen. They haven't really declined by any stretch right now. In fact, everything that we're hearing on the ground from clients is, asset values are holding pretty steady, and the demand just stays very strong for them because, again, it comes back to that scarce pool of assets and the fact that you are generating a very strong real return because your rents are benefiting from, hot inflation. If it's driven by increased demand, increased wage inflation, increased economic activity, should translate into higher rents.
Based on the conversations that you're having with your clients and large investors, what are the major thematics that are emerging?
Look, I think it's bedding down, as we're coming out of this pandemic, what is the evolution of real estate, right? I'd take office, for example, right? For the last decade or more, per capita space has been reducing. What actually happens to office in the next, 12, 24, 36 months? Does the potential of hybrid working actually create a reduction in the use of office? For a lot of people, it might actually reverse in some ways because you might need more space per person. You might need to create an environment of collaboration where there's breakout rooms and in areas where people actually want to come in to work. So there's no linear impact from a reduction in what I'd call is sort of through the week occupancy, because you might have the entire team in on a Wednesday or a Thursday, right? And you might need more space for that collaboration as well. So I think the point is there's a real estate. There's an evolution naturally, right? And I think we'll be going through another evolution of the use of real estate. But one thing that's going to stay constant is, places like we're in right now, in the heart of the CBD, I think prime grade assets will still remain very much in demand.
Some of the largest domestic real estate players are getting into the funds management space, or if they're already in it, they're doubling down on their exposure to funds management. Is that a trend that you expect will continue?
Yeah, look, I think it's a natural trend because you've got a lot of very capable management teams. There is a pool of capital, right? I mean, with savings increasing, you've got a very large, I hesitate to call it a retail base. I'd call it a private wealth base that is increasing significantly, which adds to, the super funds which have an increasing sort of AUM. So actually managing money on behalf of multiple investors is just a natural trend for a lot of them, because up until now, a lot of them were listed and they were raising money just from one source, but actually having multiple avenues of capital and partnering with multiple capital sources, I think is just a natural transition.
What are you seeing in the industrial and logistics sector? Do you think that boom that's been going on over the past couple of years has peaked, or do you still see opportunity for growth?
Yeah, look, I think, that initial boom was driven by declining cap rates. We're now moved into the next evolution of that boom, which is actually increasing rents. So it's quite interesting, the clients of ours on the private side that own some logistics assets, and they've said even for, what was previously B-grade stock, they've actually done value add projects on it, and the rental increases have been very significant in the logistics space. So, there doesn't seem anything at this stage which concerns us about either lack of demand, asset values getting impacted, because the trend is actually just in the positive direction.
From a geographic perspective, are you seeing any reweighting of exposures?
Look, I don't think from a geographic perspective, I think historically Sydney and Melbourne have really dominated real estate because that's where a majority of institutional real estate has been. I do think certain markets, whether it be WA or Queensland, etc., there's plenty of demand for product there. There's attractive portfolios of assets there as well. So I don't think there's any impact on geography specifically. I think if anything, I'd say the reweighting is just on the balance of the sectors. And this is not about reducing your office exposure, reducing retail, etc. It's about increasing some of these other sectors which are quite prevalent in the US, whether it be healthcare, whether it be more in the logistics side, any other sort of assets, self-storage, student accommodation, build-to-rent, right? We don't have institutional build-to-rent in the listed market at all. It's a develop-to-hold strategy to create that product today. So I think that reweighting is going to be natural from institutionalization of some of these assets, because mum and dad investor in a strata apartment was never considered by institutional investors as an asset class in Australia, but it is a very deep sector globally.
Let's talk about build to rent. What's your expectations on the size or scope that asset class could get to potentially in Australia over the years ahead?
I think it's immense, right? We're starting from zero, and I think it comes down to what the offering is to the renter as well. You're providing security of tenor. You're providing, arguably, you should be managing the asset a lot better as well, because you're looking at the entire building, so if there are any issues, etc., from a maintenance perspective. So you can, from a renter's perspective, you should be able to provide a better overall experience to the renter. And then, the challenge has historically been with build-to-rent is how do you make the economics work? When you compare with cap rates with industrial and other sectors which have compressed so significantly, all of a sudden, I think you can make the numbers work now. And in a diversified portfolio, I think it plays such an important role because, through the downturns, people need to live somewhere.
One of the other sectors that we haven't touched upon is the retail sector. What are you seeing play out in that space?
Look, you just need to look at the footfalls, and they're coming back, trending back to 2019 levels. In fact, I was reading some updates from the US where they're looking at 2022 as getting footfall back to where they were at the 2019 level, which is a very positive indicator. At the end of the day, I do think it's a critical part of your buying experience, and omni-channel, as we call it now, a combination of physical and online, I think is here to stay, and the good quality assets are going to do well.
Are there any other thematics that aren't being widely spoken about that you and your team are analysing?
Look, it's just, I think we've touched upon this, but it's just that evolution of real estate, right? And what actually happens, and just capital sources, new capital sources, right? 10 years ago, there weren't that many superannuation funds doing, investing in Australia with multiple managers, and they are today. Who knows where that evolution of capital might go? Are there going to be more sort of private wealth products, not just retail syndications, but private wealth and larger private wealth products that come to market over the next few years? It's one of those things. It is a constantly evolving market, and we're certainly trying to keep our ears to the ground.
And very broadly speaking, how strong do you think the domestic economy is at the moment?
Oh, look, I think the numbers sort of speak for themselves, right? The economy is strong. You're seeing, when you've got unemployment rates at where we're sitting today, that certainly bodes well for how we're heading into the year. Obviously, some of the risks are, what happens if there are too many rate rises, and what happens to the construction industry, flow-on effects to sort of residential, etc. Those are certain things that we're probably on the lookout for. But I think, broadly speaking, I think we're in a pretty strong position, and we just need to manage that inflation/interest rate risk, which I think the RBA has done a good job. They haven't panicked. They've sort of put the forefront of the economy at top of their list. So I think we've up until now we've got the balance right.
Finally, what services do the Credit Suisse real estate team offer investors or institutions?
Look, I think so Credit Suisse, in Australia, we've got, within the investment bank, we obviously have an institutional client-facing business where, last year we did a couple of IPOs. We participated in your traditional mergers and acquisitions, your private placements as well with institutions. In addition to that, we selectively use our balance sheet to assist, private groups with growth, and that can be in multiple forms, right? So it's, we're selective on how we use it, but for specific clients, we're happy to sort of deploy that. So we do that out of the real estate team alongside, we partner with our private wealth management team. We partner with our financing teams as well on these initiatives. So that for us is an interesting part of the business because you're sort of working with the listed market, and you're also working with the private market as well at the same point in time. So from our perspective, we see both of them being strong engines of growth in the real estate sector.
Rahul Bharara, Managing Director and Head of Real Estate Australia at Credit Suisse. Always a pleasure speaking with you. Thanks for your time.
Thanks, Rob. Appreciate that.